aggressive, guys. Firstly, I'd be asking you, why did you do that? I'm not being harsh, but the current situation has created the perfect blend of stupidity of people at home. Hear me out here before you cast any doubt over what I'm about to say. Cast doubt, I don't care. But retail investors have experienced a huge surge in the number of people that are opening accounts. And when I mean accounts, I mean investment accounts for trading, where emotional investing has heightened in the market. It's an interesting story for you. The Financial Times recently reported the emotional investment that was taking place around a pharmaceutical firm called Moderna Incorporated. It's actually listed on the NASDAQ. Announced a positive immune response to trials that were conducted on patients with a C word. And they're basically trying to develop a coronavirus vaccine. Subsequently, as they announced this kind of successful trial, the stock jumped up to up by 26% at the time. And once the market actually read the actual results, they realized that the trial was only conducted on 8 people. The point is, 6 months ago, this stock cost just under $20, right? After the news of the successful vaccine, it peaked to $80 per stock. Now, if you invested at that time, great, you've made some money. But now, as of today, I'm recording this video, it's dropped down again to $60. So you've still made money if you were to sell today. And I'm not casting judgment on whether this is a good stock or a bad stock. That's not the point. The point is the company has never turned a profit. And that is what would make me wary of investing. The red flag here is unseasoned, conflicted and emotional investors should not dance with fire, guys. Just don't do it. If you don't understand, if you're just making bets on whether a company will do good, it's not the right time to do that right now. So how do you invest in a crisis? 1, don't get carried away. Markets tend to use languages like boom and bust. That essentially just means excess and corrections. So avoid rash decisions as a result. Number 2, be humble and aware of what you know and what you don't know. A classic example is Bitcoin. If you don't understand what Bitcoin is, how it works, how it generates a profit, for example, don't invest in it. Similarly with biotechs, if you don't get them, if you don't understand startups, avoid them. There are better risk-adjusted investments out there where you can spread your risk into diversified funds. And those are probably the ones that you should be investing in if you don't understand the others. Number 3, set up a safety bumper. Value investors tend to look for margins of safety and build those in when it comes to picking their stocks. So for example, you might follow a set of rules. You might have a framework that you follow before you pick a stock, and you follow certain disciplines that you agree with. Look for your quality stocks by doing that all the time and leaving the emotions at the door. And before, get aggressive, guys. So market corrections are opportunities, right? So where the market sinks, that's an opportunity for you. So they generally always follow an upward trend as world economies grow, and our world is a global economy, and now is the opportunity to save more and invest more to the dollar cost average in diversified assets at their lowest points of value, which they haven't been for over a decade. Okay, so let's explain this dollar cost average a little bit. Say 3 months ago you bought £10, as in 10 money pounds worth of flour. Firstly, I'd be asking you, why did you do that? At the supermarket, right? So, and say it cost 50p a bag, but you only wanted to buy £10 worth. You will have 20 bags of flour because it only cost you 50p, because that's how much it was selling at. So now, 3 months later, suddenly the demand of flour has gone up, so that means the price has shot up of the flour, and now it retails at £1.50 a bag. Does that sound familiar, anybody? But either way, you still only want to buy £10 worth of flour. So the point is, you'll only get 6.5 bags. The same principles apply to buying stocks. Buy low and you will get more for your pound or your dollar. So number 5, be different but be right, okay? And what I'm saying there is, to try and beat the market, you have to be different, but just being different is being a little bit stupid. A personal example is when I owned Card Factory last year. and it was a complete disaster because I thought I was being contrarian in my investing strategy, and that didn't work out at all. It would have been wiser to just check the market and be okay with what the market returns were instead of trying a new strategy that I wasn't familiar with. Finally, get used to the discomfort. Everyone experiences that when you open your first ISA and you buy your first investment fund. You just think, am I doing the right thing? Like, should I be investing in something else that I can see that is tangible? But don't worry, everyone feels that. And also, it's also quite uncomfortable to buy when everyone else is selling and the markets are tanking. But know that you are building your investments, and it's sensible to build on that understanding, to educate yourself and make those informed decisions as to why you are doing something. So repeat the other steps as much as you need to. But until next time, that's all. Please like, comment and subscribe. Let me know what your thoughts are. I'd love to hear from you. Otherwise, cheers guys, bye.